What I'm about to show you is happening right now in 10 major US cities, and most people have no idea it's coming. While everyone's busy debating interest rates and inflation, entire housing markets are quietly shifting downward. I'm talking about real, confirmed 5 to 10% price drops, not predictions, but actual sales data from the first half of 2025. Some markets that seemed bulletproof just 2 years ago are now filled with for sale signs on every block. Today we're diving into something that could save you serious money or help you time the biggest real estate buying opportunity in years. Here, you get the truth, not the sales pitch. If you're new here and haven't subscribed yet, what are you waiting for? Hit that like button and subscribe for weekly deep dives into the US housing market and smart relocation strategies. Ready to go? Let's dive in. Number 10. Tampa, Florida. Tampa's housing boom was built on 3 pillars: finance jobs relocating from New York, tech satellite offices, and retirees fleeing high-tax states. But one of those pillars is cracking: property insurance costs. Picture driving through Westchase or Hyde Park today. These neighborhoods that saw bidding wars in 2022 now have homes sitting for 60 to 90 days. The reason? Insurance premiums have hit $8,000 to $12,000 annually for basic coverage. When you're paying nearly $1,000 monthly just for insurance on top of your mortgage, property taxes and HOA fees, a $400,000 home suddenly costs $3,500+ monthly to own. That math doesn't work for most Tampa incomes. Current data shows Tampa prices down 4 to 6% from 2024 peaks, with inventory levels climbing steadily. The correction here is driven more by affordability breakdown than job losses. Number 9. Phoenix, Arizona. Phoenix built its recent boom on something dangerous: speculation. When institutional investors like Blackstone started pulling back in late 2024, the market lost its artificial floor fast. Here's what's really happening. Drive through Ahwatukee or North Scottsdale and count the signs. In some subdivisions, you'll see 15 to 20% of homes listed simultaneously. That's not normal market activity. That's panic selling. The numbers tell the story. Phoenix peaked around $485,000 median home price, now down 5 to 8% depending on the area. But here's the kicker. 23% of purchases in 2023 were by investors. When they exit en masse, it's not a gentle slope downward. What you're seeing is a market that forgot homes are supposed to be lived in, not just traded like stocks.
Number 8. Las Vegas, Nevada. Number 8 brings back memories of 2008. Las Vegas, Nevada. Vegas has a fundamental problem. It's built on tourism and hospitality jobs that pay around $45,000 annually. But home prices shot up as if everyone made $100,000. That gap had to close, eventually. The market peaks near $500,000 median, now showing 6 to 9% declines across the metro. Some zip codes are down over 10% from peak. What makes Vegas particularly vulnerable is geography. Unlike coastal cities with natural building constraints, Vegas can expand in every direction. When demand drops, builders can flood the market with new inventory, creating downward pressure on existing home values. Drive through Henderson or North Las Vegas today, you'll see builders offering $50,000 plus in incentives just to move inventory. When builders are essentially paying you to buy their homes, that tells you where the market is heading. Number 7. Sacramento, California. At number 7, Sacramento, California's supposed affordable alternative. Sacramento's identity crisis is showing. The city was expensive because people would buy there and commute 90+ minutes to San Francisco Bay Area jobs. But remote work policies are shifting, and that brutal commute no longer makes sense for many. The numbers? Sacramento peaked around $565,000, now down 5 to 7% with inventory up 75% year over year. Walk through Elk Grove or Folsom. These were bidding war territories that now have motivated seller signs everywhere. The fundamental issue is Sacramento never developed its own strong economic base beyond government work. It's primarily a bedroom community. When commuter demand drops, there's not much left to support these price levels. 6. Austin, Texas. Number 6 might surprise you. Austin, Texas. The tech hub everyone's been moving to. Austin's reality check is harsh. The city peaked around $585,000 median home price, now down 6 to 8%, with major employers pulling back. Meta cut significant Austin positions. Tesla's Gigafactory scaled back production, and Oracle's expansion plans got postponed. Here's Austin's core problem. During the pandemic boom, median local incomes were around $85,000, but home prices shot up as if everyone made $150,000. That math was never sustainable. Those trendy East Austin neighborhoods where tech workers bid $50,000 over asking, now there are price-reduced signs on every block, and homes sit for months instead of selling in days. The correction here has further to go because Austin got drunk on its own success story.
Boise, Idaho. At number 5, Boise, Idaho, the pandemic winner that's becoming a post-pandemic loser. Picture this. In 2019, you could buy a nice home in Meridian for $350,000. By 2024, that same home costs $630,000. That's an 80% increase in 5 years. And now, reality is hitting hard. Boise's median home price peaked around $630,000, now down 7 to 9%, with mortgage applications down 30% year over year. The median household income is $63,000, meaning homes cost 10 times annual income. Sustainable ratios are typically 3 to 4 times income. What's driving the correction? The remote work revolution that brought everyone to Boise is reversing. Companies are calling workers back to offices, and suddenly that cheap Idaho home isn't attractive when you're facing a return to San Francisco or Seattle. The California refugees who drove Boise's boom are either moving back or discovering that Idaho winters and limited amenities aren't worth premium prices. If these market realities are opening your eyes to trends you hadn't considered, hit that subscribe button. I analyze housing market shifts like this every week, and you don't want to miss what's coming in our top 4 cities. Number 4, Denver, Colorado. Number 4 is Denver, Colorado, where home prices are coming back down to earth. Denver hit $610,000 median home price, making it one of America's most expensive mountain markets. Now, we're seeing 6 to 8% declines as economic reality sets in. Denver's job market is concentrated in tech, aerospace, and energy. When these sectors hiccup, the whole market feels it. Amazon cut over 2,000 Denver tech jobs, Lockheed Martin scaled back operations, and energy companies moved to Texas for better tax treatment. Imagine you bought in Highlands Ranch for $650,000 in 2023. Today, similar homes struggle to sell at $595,000. That's $55,000 in lost equity while you're still paying a mortgage based on the higher value. Denver's correction story is also about lifestyle costs. When total housing costs eat 45 to 50% of your income, how much time do you really have to enjoy those mountains you're paying premium prices to access? Number 3, Seattle, Washington, the city that was supposed to be immune because of Amazon and Microsoft. Seattle peaked near $850,000 median home price, but tech layoffs have been devastating. Amazon announced 18,000 global job cuts, with Seattle taking a major hit. Microsoft, Meta, and Google all scaled back Seattle operations significantly. Current data shows 8 to 11% declines from peak in many neighborhoods, with some areas down even more. When you lose the $200,000 plus tech salaries that justified these prices, there's literally no one left who can afford these homes. Picture this. Identical homes in Bellevue that sold for $1.1 million in 2022 are now selling for $975,000 when they sell at all. Many sellers are just taking their homes off the market rather than accept the new reality. Seattle also faces quality of life challenges that make paying nearly $900,000 for a basic home feel absurd. When you're paying luxury prices for a city with visible dysfunction, the market eventually corrects. Number 2, San Francisco, California. At number 2, the big one, San Francisco, California. San Francisco peaked at an absolutely insane $1.4 million median home price. The city is now experiencing systematic declines as the tech exodus accelerates. Major companies aren't just allowing remote work, they're actively encouraging it to reduce San Francisco real estate costs. Twitter's headquarters sits mostly empty. Salesforce scaled back dramatically, and dozens of smaller companies simply left. Walk through Soma or the Mission today, and for lease signs are everywhere. When commercial real estate collapses, residential follows. Condos that sold for $1.8 million in 2021 can't find buyers at $1.4 million today. San Francisco's problems run deeper than economics. The city has become fundamentally dysfunctional. Public safety issues, street conditions, and basic city services that don't function properly. Why pay $1.4 million to live with those problems? Current declines range from 8 to 12% depending on neighborhood, and this correction has further to go.
Number 1, Portland, Oregon. And at number 1, not for steepest declines, but for the most complete market breakdown, Portland, Oregon. Portland was supposed to be the cool, affordable alternative to Seattle and San Francisco. It's definitely not affordable anymore, and the cool factor is rapidly disappearing along with home values. Portland peaked around $620,000 median home price and is now seeing 5 to 8% declines. But the real story isn't just numbers, it's what's happening on the ground. Downtown Portland looks post-apocalyptic. Retail stores are boarded up, homeless encampments line streets, and crime has gotten so bad that businesses are simply leaving. Pioneer Courthouse Square, supposed to be Portland's living room, has become unusable public space. Portland's crash is different because it's not just economic, it's about complete breakdown in civic function. When city government refuses to enforce basic laws and maintain public safety, property values reflect that reality. Here's the telling statistic. Portland's population actually declined in 2024 for the first time in decades. People aren't just avoiding Portland, they're actively leaving. You can't have a functional housing market without a functional city, and Portland proves that point dramatically. So, there you have it. 10 cities where housing corrections are already underway in 2025. These aren't predictions. These are markets where price declines have started and momentum is building. This information isn't meant to scare you, it's meant to inform you. Real estate is cyclical, and understanding these cycles can save you hundreds of thousands of dollars or help you identify incredible opportunities. If you're thinking about buying in any of these markets, do your homework. Don't let emotions or FOMO drive decisions. The housing market rewards patience and punishes panic buying. For investors, some of these markets will present incredible opportunities, but timing matters. Too early and you catch a falling knife. Too late and you miss the bottom. Hit subscribe and do not forget to watch our video on the 10 cities where smart money is moving right now, showing the pairix that are actually growing, while these others correct themselves. Thinking about making a move in 2025? Drop a comment with which market you're watching. Remember, in real estate, knowledge isn't just power, it's profit. Thanks for watching, and I'll see you in the next video.